Today I'm going to be talking about why buying in a limited company rather than buying through your personal name often, if not most of the time, isn't actually a good idea to save money or make more money down the line. Now, I've just bought a house with my friend in a limited company, and I'm going to go through those reasons later on, but I want to touch on the two major drawbacks of actually buying through a limited company. So the first drawback of buying through a limited company is that your interest rate on your mortgage or your bridging, whatever, it's going to be higher. Like on average, it's going to be 1% higher than if you buy through your personal name. So the mortgage that we just remortgaged that house, it's 5.1% is the interest rate. I could have got that in my personal name at 4%. So that, although it sounds like a small number, if you're borrowing £200,000 every year, it's an extra £2,000, or in this case, just over. So you've got to take that into consideration because it's a big amount of money. We've just taken out a 5-year loan, so it's an extra £10,000 and some over those 5 years. And it's something that if you've not bought through a limited company before, you get blind. Well, I was definitely blindsided, and I've talked to other people about it, and it happens to them. So just know, if you're buying through a limited company, extra 1% on the mortgages. Now, when we got our best rate through, which was 5.1%, I said to the broker, it seems quite high. Obviously, because I've been looking at through my personal name, and they said, yeah, extra 1%. And I said, okay, why is that? So they didn't really give me an answer. So basically, I asked my solicitor, I said, obviously you deal with this. Why is it that companies charge more, lending companies charge more, if you're buying through a limited company? And she says, well, they deem it as more of a risk because you're a company rather than an individual. So I kind of took it on the chin. I was like, okay, fair enough. It does make sense because if the company goes bust, then I thought they'd be left paying the mortgage. So when we came to actually sign, this was like 5 days before we bought the property, when we actually come to sign, our solicitor gave both of us a document, and she was like, you need to sign that. And what that says is that you are liable. If the company goes bust, you are personally liable to pay that mortgage. They can take your personal assets, And I just signed it, but after about 5 minutes, I remembered that conversation we had previously about the higher interest rates, and I said to her, I thought that we have higher interest rates because it's more of a risk to them if we buy through a company. And she said, yeah, well, it is. I said, but if we're personally liable to cover that mortgage, even if the company goes bust, then why is it more risky for them? And she was like, well, yeah, it's not really. And I said, so why is it an extra 1.1% for the mortgage? And she just kind of looked at me and went, as if to say, that's just what it is, and basically they do what they want. So anyway, just something to bear in mind. So another downfall of buying through a limited company is that you have to pay tax twice. And what I mean by that is you have to pay your corporation tax on your company profits, and then when you want to draw that money out of the company, you then have to pay income tax. So this is a huge one because it's just like double taxation, and this is one of the things that I don't think people look into. So if you make £10,000 profit on a house, one house, and it's in a limited company, if it was in your personal name, okay, you would then pay your income tax, and that'd be it. So it depends what type of earner you are, basic, higher. I don't know what you are, but that's what you'd pay. However, if you're doing it through a limited company, then you pay 19% corporation tax. So now you're left with £8,100 in the company in profit. But then you can't do anything with it unless you reinvest it into the company. But if you want to bring it out and you want it to be your money, then you have to pay income tax as well. So again, you're going to have to pay, depends what, if you're a basic earner, another 20%, if you're a higher earner, 40, maybe 45%. So it's like, you're just getting taxed twice, which a lot of people don't understand. So what I'm saying is, if you can buy it through your personal name and you're a lower earner, then it's well worth doing. And the reason I say if you're a lower earner is because of the next point that I'm going to come on to. And this is a pro for buying in a limited company. So if you buy through a limited company, one of the big pros is that you miss out Section 24. And I'm going to explain what Section 24 is. Basically, a few years ago, the Tory government decided that a landlord was going to pay tax on his actual revenue, on his rental revenue, rather than his profits. So what does that mean? So let's say a landlord brings in £3,000 of rent, but he pays £2,000 in mortgage interest. So he's left with £1,000, right? So if you're left with £1,000 profit, what are you going to pay tax on? You'd think it'd be £1,000. However, the Tory government decided to make this, I don't even know what to call it. I don't know. Daylight robbery is what I would call it. But anyway, they decided, no, you're not getting taxed on the £1,000. You're getting taxed on the £3,000 of rental net. So a landlord now, if you're a higher earner, okay, and you're paying, let's say you're paying 40% tax, you pay £1,200 tax on that £3,000. But you're only making £1,000 profit. So now you're minus £200 for all of that aggravation, okay? Which, in my eyes, is it. What other business would be able to run like that? Like, who come along and thought this is okay to do? But they did it, and here it is. So if you're a higher earner, I'll be honest with you, your only way around that is to buy through a limited company. So if you're a higher earner, my advice, 100%, buy through, a limited company, because otherwise you're just going to get absolutely smoked on tax and you're not going to make any profit. And to be honest with you, the more I've talked about it and the more you understand, basically the government have done that, so you have to buy through a limited company. So yeah, Section 24, if you're a higher earner, you have to buy through a limited company to avoid that. Now, there are lots of small pros and cons when it comes to buying through a limited company or buying through your personal name. And it all depends on your individual circumstances, of course. But some people say that you can put more expenses through if you're a limited company, which it depends really. You probably can, but you can put through loads of expenses in your personal name as well. The difference is, if you're buying through a limited company, you're allowed to put, let's say, some meals through, because, I don't know, you're going out with your business partners to discuss the properties, or you're taking a tenant out to say thank you for being such a good tenant. There's all sorts of things that you can do, whereas it's a little bit harder in your personal name. If you sent to your tax man your bank statements, and you was just you're a sole trader, it was in your own name, and you said, oh, I want to put that meal through, and I want to put those drinks through, he'd be like, you can't do that. Okay, so yes, you do get away with putting more expenses through a business account, but is it life changing? No, not really. And they're going to be limited. Your accountant's not going to let you put through £10,000 worth of restaurant bills when you've only got 2 houses. He's going to be like, can't do that. So there's a limit to it. One of the major drawbacks, again, I'll go back and I'm going to finish on this one, is that if you buy through a limited company and you are refinancing, you have to be really careful what you do with that refinance money. Because usually, let's say you're buying in your personal name and I refinance £150,000, you're going to pay no tax on that because it's debt, right? So you don't pay any tax. That £150,000 is for you. You can go and do whatever you want with it. However, in a limited company, it's the same up until you try and take it out as a salary. So you can refinance in a limited company. You can refinance however much you want. So you get £150,000 and now it's sat in the company. However, if you try and take that money out, it can be classed then as salary, which means you'll have to pay income tax on it, which it really, depending on if you're a basic or higher rate, even basic, it really will kill your profits. Now, there is ways around it, of course. If you're a director, you're going to put money into the company through a director's loan. So let's say you've put £100,000 into the company. You can always bring that £100,000 back out. However, if you start trying to take more than what you've put in, you're going to have to pay income tax on it. So what I'm doing is I will only ever take out what I'm owed. Whatever I've put in, I'll take out, and the rest, it just has to stay in the company, because we're going to buy more property, so it just has to stay in the company, and then, you know, later down the line, you have to figure out the best and most tax efficient way of actually bringing it out of the company. But if your idea is to, you know, sell a property or two and take the money out straight away, again, I'd look at going into your own personal name. It's a minefield, people, and you've really got to put your own research into it, and you've got to really understand it. There's so much to understand. Speaking to an accountant is a great way of doing it. Having an accountant, but I will say this, having an accountant is great. If they're good, it's great, but I'm telling you, they will not fight for you the way that you will fight for you. So they'll miss things off, and there's things that an accountant will just not do, and there's areas where they could be saving you money, and they're just not that interested. So you need to know, especially if you're dealing with big sums of money, you need to know. So in my opinion, it's quite rare that it's better to work in a limited company. Now, if you're working as a JV partner, if you're working with a JV partner, or you've got a company and there's more than one of you in, there's 2, 3, 4 people, it being in a limited company is a great way to set it up, because everybody has the equal share, it's easy to keep the accounts, and it's basically a legal structure that allows you all to own properties in an easy way. Now, you can do that in your personal names as well, but there's pros and cons to that. If you're going into business with somebody, JV partner, or you're setting up a business with people, I would recommend setting up as a limited company. But do your own research, people, and make sure that you're the guider, right? You're the guider. Yes, you're going to have people working for you, accountants, estate agents, everything like that. But you need to know your stuff, so that if they make a mistake or they're not working for you, you can say, no, I know a better way. Okay? And that's it. Thank you for watching the video. I'll see you in the next one. Have a great day.